We talk a lot about the Fed. The Fed matters, but it does appear that oil right now kind of is in the stock market driver's seat. Would you agree with that? And by the way, you're in L.A. How expensive is the price of gas?
Well, the local gas station at the corner where I tend to fuel up is at $6.30, so a gallon. So yeah,
Whoa.
it's a bit of a biter. Yeah.
Yeah, and
So,
do you think that oil is going to
Brian,
continue to be the main driver for the stock market?
absolutely. If you look at how oil and quite frankly how gasoline prices tend to affect consumption, it's an immediate tax on consumption, and that's the big problem right now. Is that we have been in a recovery post-pandemic. It has been a somewhat fragile recovery, and that recovery can be shaken by anything. And so a massive tax on consumption like oil is just not what the economy needs right now, and you're starting to feel it directly.
Yeah, and I'm still kind of reeling from the $6.30, although that is California and Los Angeles, Gina. Thankfully, that is not a national thing yet. But, you know, some of these folks like Trafigura, by the way, one of the biggest trading houses in the world, very smart people, not always right, but they're making comments about $150 or $200 barrels. That could mean $6 national gasoline. The consumer has held up so far. Corporate earnings have looked okay. Is the worry going to be if oil stays higher for longer? How much more do you think corporate earnings, which should control the stock market, Gina, should anyway, can withstand these types of higher input costs?
Well, you know, I think the big challenge right now, Brian, is that if you look at normally oil prices would never be allowed by OPEC to get to $150 or $200 a barrel. Normally, you would see a flood of production by the OPEC nations in order to manage that price. But you have a problem that we have enormous supply constraints that have been there since the pandemic. Even, you know, and so going into this recovery, we were already faced with a constrained oil supply. And so OPEC nations are not in a position to simply open up the production spigot, flood the market with oil, and get oil prices down. And so that notion that oil prices could hit $150 is actually a potential possibility. And the longer oil prices stay over 100, the bigger the hit to GDP. You could see a significant hit to GDP just with a month at staying at these prices, because we normally don't, oil spikes are normally just that, spikes. But right now we're dealing with something that could linger, and the longer it lingers, the more it will hit GDP.
Okay, just a side note, we've got a split screen on you, Jeannie. You probably can't see it, but the NATO leaders, including President Biden, Boris Johnson, Emmanuel Macron, Olaf Scholz, and others, just wrapping up their so-called family photo in NATO as they are going into NATO headquarters in Brussels, Belgium, to talk about Putin, to talk about his war in Ukraine and possible solutions. We don't know what's going to happen from this meeting. But talk to us about the macro impact. I know you're kind of a global macro investor. You travel to London. You've got a worldview, Gina, which is, let's say, thankfully, this war ends or comes to some kind of a halt tomorrow or soon. Is that an automatic bid for stocks? And conversely, if this thing slogs on for months, it escalates, Putin gets more desperate, does that ultimately hurt the stock market? Or is this kind of, sadly, its own event, which will not mean a whole lot, maybe outside of energy prices, to the U.S. equity markets?
So strangely, Brian, you know, we looked at the last 20 wars since 1948 that had any kind of global significance. And except for one significant war, which was the Yom Kippur War, October 1973, which was a very specific set of circumstances, most wars, really, their price impact does not last longer than 6 months. And that's regardless of how long the actual underlying war occurs. And so, you know, one of the problems is that the market will eventually move past this news, and it can become its own event without having price or market impacts. However, oil prices and interest rates, those two things do matter to the stock market. And so the higher we can expect interest rates to go, or the higher that oil prices linger and push up inflation, that's where the rubber meets the road for the stock market. And that's what investors need to be watching.